And now for more on the markets, we turn to Invesco global market strategist Brian Levitt to break down a wild week in the markets. Brian, yesterday we get the bad inflation print. Markets skyrocket. Today, they fall through the floor. What do you make of the last couple of days when you take it all in context?
I think yesterday was a bit surprising. I mean, you get a consumer price index report that's worse than expected. You would expect the usual risk-off trade to move after that, and it didn't happen. I mean, it happened briefly. Today makes more sense where you've got rates going up again, so we're pushing up short rates and equities coming under pressure. And in my opinion, that's the trade until we get the proverbial pause from the Fed. And I think the market will start to sniff it out before the Fed even announces that pause. But CPI report this week suggests that we're still waiting for it. And so I think today's market action makes more sense than what we saw yesterday.
Hey, Brian, what do you think needs to happen in order for the Fed to pause?
Well, the good news is we've got inflation expectations that are anchored. So that's good long term, but you're going to need to see headline CPI come down pretty consistently. And so it'll start to happen as the year progresses. I mean, yesterday's CPI report wasn't great. It was up 0.4 for the month, consumer price index. You know, if you do 0.3 every month between now and next June, you're at 3.1% year over year. So that's a moderation. That's what the Fed's looking for. And as it happens, as the reports come in better than expectations, that's when the market's going to start to price in that recovery trade. It'll commence even before the Fed admits that they're going to pause.
Hey, Brian, just in terms of that hot inflation print that we did get yesterday, I think it did catch some, at least on the street, by surprise. Anything in that report change your view of the markets over the next month or two?
Not really. I mean, we all been hopeful that inflation had peaked, and that's probably right. But it's coming down not as quickly as we would have hoped. It's pretty clear that the goods inflation story is behind us. We see the decline in commodity prices. It's the stickiness in shelters and rents and bit wages. And so we know that that's going to be a little bit stickier. That takes, higher rates takes time to work through the residential market, but will ultimately do so. So the challenge here is the Fed's data dependent. I wish they were using more forward-looking models because the data is going to take some time. But I think it's pretty clear from all of us where it's ultimately going. So the message is near-term caution on markets. We're still in a contraction. We're still tightening. But inflation is going to come down. And usually when inflation comes down, markets do very well.
And Brian, you mentioned looking ahead. Obviously, this is a midterm election year. And I know you've been following some of the historical context between midterms and markets, especially with this last CPI print before the midterms. What is history telling us about what we can expect?
Well, what you usually find is year two of a presidential cycle is the worst with regards to returns, and year three ends up being significantly better. Now, you could just say that that's a coincidence, but if you want to set a narrative around it or reason it, it would be that it's just one less uncertainty to weigh on the market. The most likely outcome here is a divided government. Now, it's above my pay grade to tell you which way the House or the Senate are going to go, but I can watch the polls, and it suggests a divided government, which suggests not a lot gets done. And so when you're fighting inflation, you saw this in the UK. I mean, the UK is fighting inflation, and you get a budget deal that the market views as inflationary, it becomes problematic. Our midterms are going to likely lead to not a lot getting done, so not a lot of fiscal support, which I think the market will embrace. The biggest point I like to make to investors is that markets have gone up under all combinations of government. The economy has largely performed the same, whether it's single-party rule Democrats, single-party rule Republicans, divided government. Politics, elections don't matter nearly as much for markets as I think investors believe.
Brian, you said you wish the Fed used more of a leading indicator rather than the lagging that they do generally look at. What would give, I think Kathy Wood, by the way, jumped up and said, you got that right. But what are those indicators that you wish the Fed would look at that would give them a better picture of the inflation story?
Well, you've seen financial conditions tighten. We've seen the dollar strengthen pretty significantly. The yield curve is already inverted. So all of those, are suggesting a pretty bad economic outcome, or at least a recession. The other thing is inflation expectations. So typically when you're in a contraction, you start to ease economic policy. We're in a contraction and we're still tightening because we're afraid that inflation's becoming unhinged. But long-term inflation expectations are somewhere between 2.5% and 3%. This is not, 1974, where long-term inflation expectations were 10%. It's a very, very different environment. It's a unique pandemic cycle. And, if I'm the Fed and I've got the bond market 1, 3, 5, 10 inflation expectations telling me inflation's not a problem, it's going to come down rapidly, why am I tightening so meaningfully into a contraction? It raises the risks of an accident. We've tightened a lot. Let's see what it means for the economy before we keep doing more, but it doesn't matter what I think. It's the Fed's going to do what they're going to do, and we know rates are going higher from here.
So, Brian, in terms of what you're seeing with the markets, what is it signaling about their expectations for a recession? For those who don't believe we're already in one, what the expectations are for next year?
Yeah, there's a likelihood that we'll have a recession. And the major things pointing to a strong dollar, inverted yield curve. We all get that. The question is, what does that mean for investors? We've already gone down 26, 27% peak to trough in the S&P 500. The average in recession times is 31, 32%. So we've maybe done a good amount of it, but most of the market downturn has largely been a valuation adjustment due to higher rates. Valuations are more attractive now. The question is, what type of earnings hit do you get in a recession? If you figure somewhere between 10 and 15%, that could take you to earnings, somewhere around 180, 190. If you're willing to pay a 20 multiple on that, then markets are at fair value. If in that recession, inflation stays too elevated, valuations are going to come down, and we may need to see somewhat lower levels from here. But for the most part, the market, does a pretty good job of pricing these things in beforehand. Recession seems to be in the cards, but for longer-term investors, if you focus on a peak in inflation and how that comes down over time and what that means for markets, usually a buying opportunity, even if there's near-term drawdowns and volatility to have to contend with.
All right, so some buying opportunities to be had there on the cards. Invesco Global Market Strategist Brian Levitt, thanks so much for joining us this afternoon.